in cash. So we debit cash for 1,000, and we credit accounts receivable by 1,000 because they paid off their receivable. Now, how does that affect accounts receivable? Well, here we debited accounts receivable by 1,000, so we'll put a debit there. And then our last journal entry, we credited accounts receivable by 1,000, so we'll put a credit in there. So that really had no net effect on our accounts receivable. We're debiting 1,000, crediting 1,000. All right, and then we add up our debits, subtract our credits. We're left with an accounts receivable of $72,000. Letter B. All right, number 2. So this one, we're looking for the net realizable value of accounts receivable. The net realizable value is just our accounts receivable minus our allowance for doubtful accounts. So, come on, focus up, focus up. All right, come on. There we go. All right, so we've got accounts receivable at $1 million. So accounts receivable, 1 million, and we've got an ADA, or an allowance for doubtful accounts, as a debit balance for $3,000 at the beginning of the year. We're estimating that 5% of our accounts receivables will be uncollectible. This is the percent of receivables method, not to be confused with the percent of sales. So the percent of receivables, we're ultimately, or not ultimately, we're going to be calculating the ending balance for ADA. That's what our calculation gives us. It's not going to be the journal entry. So maybe you'll see that later. We're estimating that 5% of our accounts receivables will be uncollectible. So we're going to take 1 million times 5%, and that gives us $50,000. That $50,000 does not go here. It goes as our ending balance for ADA. 50,000. Now that'll confuse some students, but we want our ADA to be 5% of our accounts receivable at the end of the year. So what is our net realizable value of accounts receivable? And as I said before, the net realizable value for our receivables is accounts receivable minus our ADA. Our accounts receivable right now is 1 million minus our ending ADA of 50,000 gives us a net realizable value of 950,000. There's our answer. Now we can also, beyond that answer, you should probably know what the journal entry looks like for this problem. So we wrote off, I'm sorry, we didn't write off anything, I believe. Yep, no, we didn't write off anything. So we had a beginning ADA balance of 3,000 debit. We want it to end as a 50,000 credit. So in order to do that, we need to credit ADA $53,000. This number is our journal entry. That's our journal entry. So the journal entry looks like this. We're going to debit bad debt expense and we're going to credit our allowance for doubtful accounts by that 53,000. 53. There's our journal entry. Again, we do not journalize this 50,000. We journalize what we need to get to that 50,000. At least that's for percent of receivables. Percent of receivables is a little tricky, as you can see. Alright, moving on to number 3. We're given an aging schedule now. When you see an aging schedule, you should automatically think of percent of receivables, like what we just did. The only difference is that now we've got different percentages. The older that the accounts receivable is outstanding, the more likely or the more we assume we won't collect it. So our really old accounts receivables, we think 40% won't be collectible. Our kind of newer accounts receivables, we believe 1% are uncollectible. So, I'll write that down here, 1 through 30, 30 through 60, greater than 60. We've got 20,000 that have been out for more than, or 1 to 30 days, 12,000, 30 to 60 days, 4,000 more than 60 days. And at 1%, 20, 40. So we multiply these across. We believe 1% of our 20,000 receivables is uncollectible. That gives us $200 uncollectible. 20% of this is 2,400. 40% of 4,000 is 1,600. Added up, that means we believe $4,200 is uncollectible. So again, percent of receivables are what we calculate is going to be the ending ADA balance. So there's my T account. Automatically put it as the ending balance. It's not going to be in the journal entry. What is in the journal entry is whatever number that is. Whatever number we need to get to the $4,200. So going back to the facts, assume at the estimation of the ADA has a $300 credit balance. Whoops. $300 as a credit in the beginning, and that there is a write-off for $250. So a write-off, if we write off $250, our journal entry is a debit to ADA for $250 and a credit to accounts receivable for $250. When we write off something, we know for sure that we won't collect this money. So we're going to decrease our accounts receivable by $250, and we're going to decrease our allowance, the amount that we've set aside that we think we won't collect. We're going to decrease our allowance by $250. So how does that affect this T account? We debit ADA, so there's our debit. Okay, and now that's all that happened this year. We've got to figure out what number makes this T account correct. So the answer, well, one way you can do it, it's kind of hard to figure it out, especially, well, it's a little tricky trying to figure out this number. What I usually do is I ignore the current balance, or this ending balance, and I say, what does it currently add up to? We've got 300 as a credit, 250 as a debit. That means 300 minus 250, I've got a $50 $50 as a credit right now. If I have $50 in my credit side and I want $4,200, what's the number I need to have? Well, hopefully that's fairly obvious. I need 400 or 4,150. So there's my journal entry. We're crediting ADA, so my journal entry for this will be a credit to ADA for 4,150. My debit is going to be bad debt expense for 41,500. And this should probably be moved out a little bit more. But there's my journal entry. Debit 4150 to bad debt, credit to ADA. So here's my estimate. Here's my write-off. Yep, that's all we gotta do for that one. All right, number 4, we've got a percentage of sales. So this is percentage of sales. We've been doing percent of receivables this whole time. So we're going to do this a little bit differently. They estimate that 3% of their credit sales are uncollectible. 3% of our sales are uncollectible, our credit sales, I should say. We've got $250,000 in credit sales, $10,000 in write-off, and we're going to record the journal entry. Record all of the journal entries necessary. So let's start with the sale. We sold a bunch of stuff and we got $250,000 in credit sales. So the journal entry to record a credit sale is our accounts receivable. They owe us $250,000 and we credit our sales revenue for the same amount. So there's the recording of the sale. Now we're going to take our estimate. 3% of our sales are uncollectible. So 3% times 250 is 7,500. So we're going to debit our bad debt expense. And we're going to credit our allowance for doubtful accounts. So there's our estimate. And now finally our write-off. We know for sure that we can't collect this $10,000. So we know for sure we won't collect $10,000 from accounts receivable, so we're going to take away $10,000 from our accounts receivable. We're going to credit accounts receivable. We're also going to take out of our ADA $10,000. So if you're having trouble with all these allowance questions, the big two journal entries that you should know are these two. A debit to bad debt, a credit to ADA. A debit to ADA and a credit to AR, or accounts receivable. So this is whenever we write off something. Whenever we know for sure we won't collect something, this is the journal entry that we make. Anything other than a write-off, when like it's an estimate of what we won't collect, this is the journal entry we make. A debit to bad debt, credit to ADA. So that's percent of sales. It's a little simpler than percent of receivables. And moving on to the last chapter, our depreciation of equipment and other PP&E. So this first one, we're going to go through all the different depreciable methods. We've got straight line, double declining balance, and units of activity. So we'll first start with straight line depreciation. Straight line is just taking our cost minus our salvage value divided by the useful life. Whatever we get here is the amount we'll depreciate every single year. It's the same amount every year for straight line. Okay, so on January 1st, we bought we bought a piece of equipment for $65,000. So there's my original cost, $65,000. We expect it to have a $5,000 salvage value. There we go. At the end of its 10-year life. Boom. 65,000 minus 5,000, 60,000 divided by 10 is 6,000. That's how much we're going to depreciate it every year for 10 years. So, under straight line, what is the depreciation expense in year 1? What is it in year 5? So in year 1, our journal entry will say depreciation expense for $6,000. And we're going to credit accumulated depreciation on the equipment for $6,000. That's the end of year 1, I should say. At the end of year 1, we record our depreciation. At the end of year 2, we record the same journal entry. At the end of year 3, we record the same thing. 4, 5, 6, 7, all the way to the end of year 10, we record this same journal entry. With number 1, it doesn't say this, but I'm going to add this in, and we're going to sell this piece of equipment. I don't know if you can read this well. We're going to sell this piece of equipment for $55,000 cash on April 1st in year 3. What's our journal entry for the sale of the equipment? First, since we're selling it kind of in the middle of a year, we need to record our depreciation. So usually we record our depreciation at the end of the year. But now now that we're getting rid of this equipment kind of in between the year, we've got to record that amount of depreciation that we've gone through in year 3. So since we're still dealing with straight line, we're going to do the exact same thing. We've got a $65,000 piece of equipment. There's its salvage value of $5,000 divided by 10 years, $6,000. Same equation as up here. We depreciate the equipment by $6,000 every year, but we only want to depreciate it for January, February, March for 3 months. And don't go like January, February, March, April, because we're selling it at the very beginning of April. So we've gone through January, we've gone through February, we've gone through March. 3 months. So we're going to take 3/12 of the 6,000. So that gives us $1,500, and that's how much depreciation we'll depreciate it for in year 3. So on April 1st, year 3, we're gonna debit our depreciation expense by $1,500. Credit our accumulated depreciation for the equipment by the same amount. Alright, there's the first part of our journal entry. Recording the depreciation. Now we record the sale of the equipment. So the easiest thing to identify is that we're getting $55,000 in cash. So we're going to debit cash for $55,000. I'm going to make a T account for our equipment and for our accumulated depreciation. So, when we bought the equipment, we bought it at $65,000. So we've got $65,000 in equipment. At the end of year one, we put $6,000 in our accumulated depreciation. So $6,000 as a credit. At the end of year two, we did the same thing. We put another $6,000 in our accumulated depreciation. In year three, we only put $1,500 in our accumulated depreciation. So $1,500, giving us a grand total for accumulated depreciation of $13,500. It's a little messy. We've got $13,500 in accumulated depreciation, and we've also got $65,000 in equipment. Since we're selling this equipment, we're going to get rid of this number, and we're going to get rid of this number. The way we do it is we credit our equipment by $65,000. Equipment, $65,000. And we want to get rid of this number as well. So we're going to debit accumulated depreciation by this amount. Accumulated depreciation for the equipment, $13,500. Now it's not balanced yet, and there's one more thing we got to figure out, and that's how much did we gain or how much did we lose in this transaction. Now you can simply just say, okay, I've got $65,000 in my credits right now. I've got $68,500 in my debits. So I need $3,500 in my credit. You can think of it that way. $13,500 to make it balance. And then you would know that a credit is a gain. Gain on sale. If it was a debit, it'd be a loss on the sale. Now you can do it that way, or you can think of it logically. So, and it's fairly simple. All you do is look at your T accounts. We've got a 65. Here, let me start by saying, so on the balance sheet, under our balance sheet, we'll have something saying, okay, we've got equipment for $65,000. Right under it, we've got accumulated depreciation on that equipment for $13,500. Our net book value is $5,000. Jeez, come on. One sec. Don't want to mess up. 51,500. So on our books, we've got a piece of equipment that is valued at $51,500. We're getting $55,000 in cash. So if our books say that we have a piece of equipment that's worth $51,500, but we're getting $55,000, that difference is a gain because we're getting more than what it's valued at. 55 minus 51,500 is the gain. And there's our journal entries, our depreciation, and then recording the sale. Okay, moving on to the last page. Number 2. Under double declining balance, what is the depreciation in year 1 and 2? So, with double declining balance, it's the same facts. We've got a $65,000 piece of equipment, salvage value of $5,000, and a useful life of 10 years. With double declining balance, we ignore salvage value. At least for the first years. So, what we do with double declining balance, we're going to double our straight line rate. Our straight line rate is always going to be 1 over our useful life. There's our straight line rate, or in other words, 10%. With double declining balance, we're just going to double that. So we've got a rate of 20%. We're going to use that forever, or not forever, but for all 10 years, we're going to use 20%. Never changes. So we've got $65,000 of equipment. Ignore the salvage value. Here's $65,000. Our net book value. We're going to take our rate of 20%, multiply that across to get $13,000. That's how much we're going to depreciate the piece of equipment. We're depreciating it 20%. So our new net book value is taking our original value minus how much we depreciate it by, giving us 52,000. 65 minus 13 is 52. Now we take that new net book value and multiply it by our rate. 52 times 20% is 10,400. That's how much we're going to depreciate it in year 2. So we take our net book value at the beginning of the year minus the depreciation we're going to take away this year. Leaves us with 41,600 as our new net book value, and then we just continue that every year. So here's year 1, here's year 2, and we'd continue doing that pattern for the next 10 years. So what's the depreciation in year 1? Well, obviously, there's our depreciation in year 1, and then there's our depreciation in year 2. So that's double declining balance. Probably the most complicated of these, well, maybe it's not, I don't know. It's harder than straight line, definitely. So, moving on to units of activity, number 3. Under units of activity, what's the depreciation in year 1 and 2? So going back to the facts, wrong one. So we just skipped over, so we've got, again, $65,000 piece of equipment, salvage value, life. We estimate that it's going to produce 200,000 units. In the first year, it produces 34,000 units, and in the second year, it produces 45. So, what we do there is it's kind of similar to straight line. We take our $65,000 piece of equipment minus our salvage value of 5,000, but now we divide it by the total amount of units we expect it to produce, 200,000. So these are all dollar amounts. This is units, 200,000 units. And from there, that gives us 30 cents per unit. Every time this piece of equipment creates a unit, we're going to depreciate it 30 cents. So, in year 1, we produce 34,000 units. 34,000 units. We're going to depreciate it by 30 cents per unit. So multiply 34 times 30 cents. And that gives us $10,200. Again, we'll do that for the second year. In the second year, we make 45,000 units, times it by 30 cents per unit, and we'll depreciate our equipment by $13,500 in the second year. And if you wanted to think about the journal entries for this, in year one, we're going to depreciate the equipment by $10,200. So we debit depreciation expense by $10,200, and then we credit accumulated depreciation by the same amount. Debit depreciation expense, credit accumulated depreciation. Same journal entry that we do every time we depreciate. Alright, moving on to the last two questions. Number 4, assume the same facts, except that the equipment was purchased on September 1st instead of January 1st. What's the depreciation year 1 and what's the depreciation year 2 using straight line? So going back to straight line, we take our value minus our salvage value divided by 10, and there's our straight line. That gives us $6,000, but we're depreciating our equipment $6,000 for a full year. In this problem, we bought the equipment halfway, or a little, we bought it not at the beginning of the year. We bought it kind of through the year on September 1st. So we held on to that equipment for September, October, November, December. 4 months. 4 months out of the 12, we're going to depreciate this equipment. So 6,000 times 4/12 is $2,000. There's our depreciation for year 1. So in year 1, at the end of year 1, we're going to say depreciation expense for $2,000, accumulated depreciation for $2,000. There's our journal entry. Now, what's the depreciation in year 2? Well, in year 2, you might think that we debit depreciation expense for $2,000 since we're doing straight line. Well, you'd be wrong. We are depreciating this equipment for a full year in year 2. Year 2 end. So we're going to depreciate it by $6,000. We had the piece of equipment for only part of the year, so we only do part of the full depreciation. In year 2, we had it for the full